If you look at the headlines today, you see a world obsessed with the trivial. We are fixated on the daily fluctuations of the stock market, the latest political scandal, and the illusion of steady growth. But while the band plays on the deck of the Titanic, a silent mathematical countdown has begun in the engine room. There's a specific date that the smart money is watching with terror. It is a date that does not appear on any election ballot, yet it will determine the fate of your life savings more than any president ever could. We are rapidly approaching the 2026 debt wall. Most investors operate under the comfortable delusion that financial crises are random events. They think they are black swans, unpredictable shocks that come out of nowhere. They are wrong. The next crisis is not a probability, it is a scheduled appointment. It is built into the maturity schedule of the United States Treasury. Between now and the end of 2026, a staggering $8.9 trillion of U.S. government debt will mature. Let's pause and visualize that number. $8.9 trillion. That is more than the combined GDP of Japan and Germany. It is nearly a third of the entire U.S. national debt, all coming due in a condensed window of roughly 24 months. This is not a theoretical problem for the future. This is the bill coming due for the party we already threw. To understand why this is catastrophic, you have to understand when this debt was issued. Most of these bonds were sold during the zero interest rate policy era, the years following 2008 and the pandemic stimulus of 2020. Back then, the Federal Reserve had pinned interest rates to the floor. The government could borrow trillions of dollars for virtually nothing. 0.25%, 0.5%, maybe 1%. It felt like free money. Politicians on both sides of the aisle gorged themselves on cheap credit. They acted like a homeowner, taking out a massive adjustable rate mortgage, assuming the teaser rate would last forever. But here's the trap. The teaser rate is expiring. When that $8.9 trillion matures, it doesn't just disappear. The government doesn't have the cash to pay it back, so they must roll it over. They have to issue new debt to pay off the old debt, but they are refinancing into a completely different world. We are no longer in the 0% utopia. We are in a world where the risk-free rate is closer to 4% or 5%. Think about the math. If you refinance $1 trillion from 0.5% to 5%, your interest expense doesn't just go up a little, it increases by a factor of 10. This is the interest rate shock that has not yet hit the headlines because it operates on a lag, but by 2026, the wave hits the shore. This leads us to the most terrifying concept in macroeconomics: fiscal dominance. Normally, the Federal Reserve is the master of the economy. They raise rates to slow things down, they cut rates to speed things up. But in a state of fiscal dominance, the interest on the national debt becomes so large that it overrides everything else. The U.S. government is already paying over $1.1 trillion a year just in interest. That is more than the entire defense budget. It is more than what we spend on Medicare. We are now spending more to service the past than to defend the future. And remember, that $1.1 trillion figure is based on the current average interest rate of the debt, which is still relatively low because of those old bonds. As the 2026 wall hits, and that $8.9 trillion gets repriced at 5%, the interest bill won't be $1.1 trillion. It will surge to $2 trillion, then $2.5 trillion. This creates a death spiral. The government has to borrow more money just to pay the interest on the money it already borrowed. This is the definition of the Minsky Moment. Hyman Minsky defined the final stage of a credit cycle as Ponzi finance. It is the point where the borrower's income from cash flows cannot cover the interest payments. They are functionally insolvent, alive only because lenders keep giving them new money. But who are the lenders? Who has the capacity to buy $8.9 trillion of U.S. debt in the next 2 years? China is selling, not buying. Japan is struggling to save its own currency. The BRICS nations are moving away from the dollar. The buyer of last resort is the only one left, the Federal Reserve. And this forces them into the ultimate checkmate. They must choose. Do they let the U.S. government default? Or do they print the money to buy the debt, unleashing hyperinflation? History tells us they will choose the printing press. They always do. And that decision triggers the events of Part 2, because we have seen this movie before. In 1931, the British Empire faced this exact same mathematical wall. And what happened next is a warning that every American needs to hear. To understand the future of the American dollar, we do not need a crystal ball. We simply need a history book. History creates patterns, and right now the United States is tracing the exact footsteps of another dying superpower. The year is 1931. The place is Great Britain. For a century, the British pound sterling was the world's undisputed reserve currency. It was the king dollar of its age. Global trade was settled in pounds. Central banks from Tokyo to Paris held pounds as their primary asset. The phrase, sound as the pound, was not just a slogan, it was a religious belief. But beneath the surface, the empire was rotting. Britain had emerged from World War I victoriously, but financially broken. They had accumulated massive debts to finance the war, largely owed to the rising power across the Atlantic, the United States. By 1931, Britain was suffering from the twin deficits. They were importing more than they exported, and the government was spending far more than it collected in taxes. Does this sound familiar? It should. It is the exact economic profile of the United States in 2025, but the British politicians refused to accept reality. They suffered from imperial arrogance. They insisted on maintaining the gold standard. They promised that every paper pound could be redeemed for a specific amount of physical gold forever. But the foreign markets, the smart money of the 1930s, started doing the math. They realized Britain didn't have enough gold in the vault to cover the paper they had printed. The ratio was dangerously thin. So the silent run began. France and the United States began quietly redeeming their paper pounds for physical gold bars. They wanted the asset with no counterparty risk. Week after week, the gold drained out of London. The lifeblood of the currency was bleeding away. The Bank of England tried to bluff. They raised interest rates to try and attract capital, punishing their own citizens to save the currency's reputation. It didn't work. The math always wins. The climax arrived in September 1931. This is the timeline of a collapse. On Saturday, September 19th, as the run on the bank accelerated, the Bank of England issued a defiant public statement. They declared that the defense of the pound was absolute. They stated that the gold standard would never be suspended. They looked the public in the eye and promised safety. That was Saturday. On Monday, September 21st, just 48 hours later, Britain suspended the gold standard. They defaulted. The promise was broken. The chain was cut. Overnight, the pound sterling lost 25% of its value against the US dollar and the French francs. Imagine waking up on Monday morning and finding that your savings, your pension, and your salary were worth 25% less on the global stage. Import prices skyrocketed. The cost of living surged. The middle class was decimated. But here is the crucial lesson. Not everyone lost money. Those who held their wealth in paper claims, bonds, bank deposits, insurance policies, were the victims of the reset. Those who held physical gold and real assets were protected. In fact, in nominal terms, their wealth skyrocketed overnight. The empire didn't vanish. The island didn't sink. But the financial order was reset to reflect reality. Today, the United States is Britain. The Federal Reserve is the Bank of England. And 2026 is our 1931. But there is one major difference between 1931 and today. In 1931, the run on the bank was done by governments. Today, the run has started in the physical commodities market. We are seeing a phenomenon called decoupling. This is when the paper price of an asset, the price you see on your screen, stops reflecting the reality of the physical world. Look at the silver market. This is the canary in the coal mine. The world is currently in a structural silver deficit. For 4 consecutive years, we have consumed more silver than we have mined. Solar panels, electric vehicles, AI servers, they all require massive amounts of silver. It is the most conductive metal on Earth. The physical warehouses in London and New York are bleeding inventory. The stockpiles are dropping to critical levels. Yet, the paper price is managed. The big banks trade millions of paper ounces that don't exist, creating an illusion of abundance. But watch the hands of the magician carefully. Banks like JP Morgan have amassed the largest physical hoard of silver in history. Why would they suppress the paper price while hoarding the physical metal? Because they know the squeeze is coming. They know that when the 2026 debt wall hits, the paper market breaks. And when the paper market breaks, the price mechanism resets, just like the pound in 1931. But silver is just the sidekick. The main character in this reset is gold. And the math behind gold suggests a price that most people think is impossible. Most people look at the price of gold and think, wow, gold is getting expensive. They have it backwards. Gold is not changing. Gold is the constant. It is the measuring stick. It is the dollar that is changing. It is the dollar that is shrinking. The price of gold is simply a reflection of how much faith has been lost in the currency. And if we look at the raw data, the Federal Reserve has a massive problem that nobody is talking about. It is the ratio between paper money and real money. Let's look at the M2 money supply. This is roughly the total amount of cash and checking deposits in the U.S. economy. Right now, that number is over $21 trillion. Now, let's look at the U.S. gold reserves. The gold sitting in Fort Knox and West Point. The U.S. Treasury claims to hold approximately 261 million ounces of gold. At the current market price of roughly $2,600 an ounce, The value of that gold is about $680 billion. Do the math. 680 billion is roughly 3% of the 21 trillion money supply. This is historically dangerous territory. Every time in history that the gold coverage ratio has dropped near zero, the currency has failed or been reset. To restore confidence in a currency after a crisis, like the one coming in 2026, history suggests you need a gold coverage ratio of at least 20% to 40%. This is what Russia is doing. This is what China is doing. They are building a floor under their currencies. So let's run the simulation. Let's assume the 2026 debt wall triggers a crisis of confidence. The Federal Reserve needs to recapitalize its balance sheet. They need to prove the dollar is worth something. If they were to revalue gold to back just 40% of the M2 money supply, what is the price? Take 40% of 21 trillion. That is $8.4 trillion. Divide that by the 261 million ounces of gold the US owns. The price comes out to over $32,000 per ounce. Even if we are conservative, even if we aim for just 20% backing, the bare minimum to stop hyperinflation, the price of gold would need to be over $16,000 per ounce. This is not a fantasy. This is balance sheet accounting. The gap between today's price of $2,600 and the math price of $16,000 is the measure of how undervalued gold is. Or rather, it is the measure of how overvalued the dollar is. And remember, the government can change the price overnight. They have done it before. In 1934, President Franklin D. Roosevelt signed the Gold Reserve Act. With the stroke of a pen, he revalued gold from 2067 to $35. That was a devaluation of the dollar of nearly 70%. It happened instantly. When the 2026 crisis hits, they will do it again. They will revalue their gold reserves higher to wipe out the debt on their balance sheet. If gold goes to $20,000, the Treasury suddenly has $5 trillion of new equity. It solves their problem, but it destroys your savings. Because while the government's gold goes up, the purchasing power of your bank account goes down by the same amount. This is the reset. It is a transfer of wealth from the private sector to the public sector. It is the only mathematical way to solve the 2026 debt wall without declaring bankruptcy. The debt is denominated in dollars. The government can print dollars. Therefore, they will print. But printing money creates inflation. To hide the inflation, they will implement financial repression. They will force pension funds and banks to buy their debt. They will implement capital controls to stop you from exiting the system. And this brings us to the final piece of the trap, the technology that makes it all possible. Because unlike 1931, they don't just control the banks. In 2026, they want to control the currency itself. They are building a cage, and the door is about to swing shut. We have established the problem, a 2026 debt wall that cannot be paid. We have established the historical precedent, the 1931 British collapse. And we have established the mathematical necessity, a massive devaluation of the dollar against gold. But the government has one final card to play, a card that didn't exist in 1931. They know that when the crisis hits, people will try to flee the dollar. You will try to take your money out of the system. To stop this, they need a way to lock the doors. They need central bank digital currencies, or CBDCs. This is not just a new form of money. It is a control grid. In the chaotic aftermath of the 2026 default, they will present CBDCs as the solution. They will say, the banking system is broken, but don't worry. Open a direct account with the Fed, and we will deposit your stimulus checks instantly. It sounds convenient, but it is a trap. Once you are in the CBDC system, your money is programmable. They can impose negative interest rates. If you don't spend your money, they can deduct 5% a month from your balance. They can force you to spend. They can dictate where you spend. This is the ultimate tool of financial repression. It stops you from buying gold. It stops you from exiting the system. The 2026 debt wall is the crisis. CBDCs are the mechanism to force you to pay for it. So, what do? How do you protect your family from a mathematically guaranteed collapse? You must build an ark, and you must build it before the rain starts. Step 1, eliminate counterparty risk. In a systemic reset, anything that relies on someone else's promise is a liability. Bank deposits are not money. They are an unsecured loan to the bank. Stocks are entries in a digital ledger. You need assets that simply are. Assets that do not require electricity or a politician's permission to exist. Step 2, secure physical precious metals. Gold is the wealth preserver. It is the tier 1 asset of central banks. If they are buying it, you should too. Silver is the wealth multiplier. It is the most undervalued asset on the planet. When the paper manipulation breaks in 2026, silver will likely outperform gold by a factor of 3 or 4. But remember, If you don't hold it, you don't own it. Do not buy paper gold, GLD, SLV. That is just another claim on the system that is failing. Step 3, hard assets and self-reliance. Land, productive farmland, energy independence. These are the things that hold value when the currency resets. The goal is to become your own central bank, to be sovereign. The year 2026 is fast approaching. The timeline is set by the maturity of the debt. The politicians will not warn you. They cannot. To warn you would be to trigger the panic they fear. They will keep the music playing until the very last second. But now you know the truth. You have seen the math. You understand the debt wall. You see the fiscal dominance. You recognize the 1931 pattern. The window of opportunity to convert your paper wealth into real wealth is closing. Today, you can trade worthless paper digits for historic amounts of gold and silver. Tomorrow, that trade may be impossible. The 2026 reset is inevitable. Your participation in it as a victim is optional. Make your choice while you still have one.